Welcome to Opal STV. Today I'm in Stockholm together with Thomas Stridsman. Thomas is a famous author and he also runs the Alfakraft Commodity Fund. The Alfakraft Commodity Fund was set up in 2010 and has since then annualized 7% positive return, which is a vast outperformance regarding or compared to many other commodity funds. So I'm curious to hear from Thomas. Tell us more about your history, your background and how you actually run your fund.
I started in the industry in the early 1990s, and in the later part of the 1990s I was working as an editor for Futures magazine in Chicago as their systems trading expert, and eventually I landed a book deal with McGraw-Hill, and this book was going to be on systems trading and money management, as opposed to just a book on systems trading or just a book on money management, which was all you had back then. So basically I believe I was the first that sort of tried to connect the dots between the two areas of research. So already back then I realized that money management is just so vastly more important than any type of entry-exit strategy you're using. So I decided to focus my research to this area. And in doing so, I took a long break at one point from my usual strategy research, entry-exit type research, to focus on what were my competitors doing in regards to money management. And I could distinguish two groups. One group, those who had prevailed and done really good into the new millennium, and those who had a significant drop in performance coming into the year 2000 and thereafter. So then I tried to figure out what are the better guys doing. And I did a lot of analysis, regressions between their performance and various macroeconomic factors and so on. And from there I built my money management algorithm to rest on top of my entry-exit strategies and the more common, simple, volatility-based money management. And I think this money management is what has made all the difference between my performance and those performance from my peers or what you see in the benchmark. My entry-exit strategies are actually very simple, and I'm not ashamed to say that. You can pick them up in any book. It's the money management that makes all the difference.
So Thomas, you talked about the significance of the money management tools, but can you give us more specifics? How do you actually do it now?
Basically, it's a type of fundamental analysis, yet quantified. I have a certain number of time series that I do quantitative analysis on as an overlay over my regular money management and entry-exit strategies, and they are giving me then the position number, how much to risk, how many positions or contracts to put on, etc. I have seen a lot of managers that are very good at being systematic when it comes to entry-exit, but when it comes to size, they sometimes override it from the top of their head. They think the interest rates are going one way or the dollar is going the other way or something like that, and then they adjust the position from the top of their head. I do nothing of the sort. All that stuff is very quantified and in the code, and it gives me a clear number for every trade, contract-wise, how many contracts to put on. And in terms of the markets or the terms of the time series that I have, for example, I will not trade the S&P 500 index because it's one of the time series that goes into this fundamental analysis. I also don't trade short-term interest rates for the same reason. They are also a factor going into this analysis. So these markets that goes into the fundamental analysis, I basically have a position on implicitly all the time, thanks to the fact that they are in the algorithm for position sizing. But basically, That's the secret sauce. A few fundamental markets that goes into a quantitative analysis that give me the size rather than when to entry and exit.
So Thomas, you talked to us what you actually don't trade because certain factors are already in your model. So please explain to us what sectors and what instruments do you actually trade?
Well, basically I trade everything else that is liquid. I have subdivided my portfolio into 6 sectors where you have the agricultural commodities as one, you have energies, metals, interest rates, long-term rates then, currencies, and did I miss one? Indexes. And I treat them all equally. I do no inter-sector weighting or no weighting between the sectors. If I get a position and size for one market, it's for that market or that position only. The markets within my portfolio does not affect each other size-wise. There are no correlation analysis, there are no diversification considerations or things like that. And currently we have about 30 to 35 markets in the total portfolio over these 6 sectors. Basically the most liquid markets.
Okay, Thomas, you talked about the importance of money management tools and how it positively affects the performance of your fund. We also talked about the instruments you trade. Now, last question, tell us more about your actual trading style.
Well, Matthias, it's funny you ask, because over the last few years, I have probably specialized or totally focused in what is generally regarded by the industry, the strategy that has underperformed everything else, which is short-term trend following. To me, short-term trend following is average holding period for any type of position around 10 to 12 days. A losing trade for me usually lasts between 5 and 6 days, and a winner goes on for like 20 or longer. But the funny thing is that a lot of larger trading houses, such as Winton or Transtrend and so on, they have produced analysis where they have showed that among the trend following strategies over the last 5 to 8 years, short term is the one that has done the worst. And I have actually been one of the better ones. And for this, I thank my money management overlay strategy, of course. But I also think that not only have I decided to be short-term trend following, I have decided to be only short-term trend following. Because for many larger players, they might be long-term trend following as a base strategy. But then they have 1, 2, 3, 4, 5 different other types of strategies on top of that. Relative strength strategies, counter trend strategies, and so on. And I believe you're only paying your broker doing that. You only have a bunch of trades going every which way, and in the end you end up with a sort of a suboptimal position when that rare trend actually happens that you need to catch to remain competitive. My strategy is a few short-term trend following strategies that tries to catch various portions going in and out of a longer-term trend, almost momentum based, you might say. And hopefully then I'm optimally allocated when the trend is the strongest, and I have a smaller positions thanks to a few exit when the trend is the weakest. I also tend to risk the least initially because I'm only on with one strategy initially. And also at the end of a trend, I get phased out strategy by strategy until I'm flat in the position. So I believe this is the optimal way to go. I also think I'm doing my investor a favor by specializing in one thing and leave it to the investor to find other guys, completely other traders, other companies that might be better in other areas. I'm not claiming those areas. I want to be the best short-term trend follower there is for you and be your alternative in that specific area.
So Thomas, that's very interesting. Now, please tell us more about your investor base.
Well, Matthias, let me qualify that answer first to say that over the years, it has become much harder for upstart CTAs or younger hedge funds to immediately attract institutional money. So we have deliberately set up sort of a three-step process where we are currently have a very dedicated sales team employed with us that are working sort of the retail high net worth individual market in Sweden and Scandinavia, and they do so with good connections with financial advisors around Scandinavia. And we are about to phase ourselves into step number 2, which is smaller institutions, and step 3 immediately following, going for larger institutions. And the interest is definitely there. We do have a lot of built up contacts. These firms just need to see us be a little bit bigger first, and we will provide them with exactly that over the next year or so. It used to be, Matthias, that 3-year track record, and a good one, of course, would be enough to start attracting bigger institutional money, but it's not that easy these days. You usually need at least 5 years and still remain competitive. For sure, we have been competitive, and we have just passed the 5-year track record mark. So in line with what I said about taking it to the next phase, step 2 and step 3 in our plan, we are just about to venture into that.
Thomas, you have been in the industry for 20 years, since '95. So tell us, share with us some observations about the industry, about the growth, about the development, particularly in the commodities trading sector. And where do you think commodity trading is heading?
Well, Matthias, from where I'm sitting, based on my interests and my expertise, the first thing I see and what I have seen over the year, I hope I can say that I actually started with my book, connecting the dots between position sizing and the actual strategy. Nowadays, you see a lot of this around, and I'm not that unique anymore, that people emphasize position sizing already at the early stage of the strategy building or research process. One consequence from that is also that the players, the traders or the researchers have become much more sophisticated. The methods used are sort of, so to speak, way more mathematically or academically correct. You need to know your statistics these days, for example. You really need to understand your math and probability analysis and so on. And this is what I have seen over the years up until now. Looking forward, I think things will go even worse. You need to be even more dedicated, and you need to be super good at what you're doing, because we will start to incorporate totally different tools, such as data science, as it's called these days, machine learning. You could see a little machine learning already in the 90s, but finally the computers are strong enough to actually let you implement those things. We in the business, we will start stealing ideas and concepts from companies such as Google or Amazon or Netflix or Facebook. In fact, we will start using the exact same techniques as these guys are doing for making you buying more books. We will use those techniques for finding better entry and exit and more precise money management algorithms. There would be very little difference between what we are doing and what Facebook are doing in terms of tools used and analysis techniques applied. Well, another thing I have observed over my years in the industry is that the industry suffers from one huge not invented here syndrome, meaning that larger CTAs, or smaller for that matter as well, if they have not developed the strategy or the concept behind some new process themselves, they are very afraid for taking on that expertise by maybe buying another CTA company or just hiring CTAs or traders from existing companies. A lot of it is about hiring directly from universities and train these people in-house. And I believe we need to go more towards not being afraid of buying or maybe investing for a large CTA to invest in a small CTA. Basically like Facebook is buying some small upstart for X hundred millions. We need to start seeing that in the industry as well, because the investor is losing out. We are performing suboptimally. We are not giving the maximum performance that is possible by constantly being afraid of the not invented here syndrome. In fact, Matthias, if you compare the CTA or the hedge fund industry where I'm at with these companies that I just mentioned, Google, Facebook, and the like, you could say there is a lack of innovation in our sector that really doesn't need to be there. In a way, the innovation is actually there, but the big companies are afraid to take it on. They should be more willing to look at smaller CTAs or smaller trading outfits and actually incorporate them in their existing organizations, instead of trying to or feeling a need for having to invent it again themselves. That just takes too long. Also, Matthias, the other thing that investors should be concerned about is how difficult it is regards to regulations and so on for a small guy to set up a shop. Very, very expensive. And the guys that still try to do that, these are the dedicated guys. These are the guys that are super interested in sort of solving the problems of the market and how to make a dollar trading, you know. So to do a favor to the investor, the bigger players, which I hope to be one soon, we should take up the smaller dedicated guys and incorporate them in our shop and let them come with their ideas, not being afraid for the ideas not having been invented here. Because you need to support the highly dedicated guys. They are the ones that can add that extra return. For me, there is no reason for why larger CTAs are not outperforming me. I mean, they have dedicated research teams of 20, 30, 40 people, and here we are a very small shop with one or two guys, and I am staying ahead of them. I'm not the only one. There are other smaller CTAs that are doing the same, so I'm not unique there. But that just shouldn't have to be the case if the larger CTAs actually built their businesses correctly. And for the investor is losing out. At least for as long as he's not investing in me or my smaller peers. But investing in the larger CTA, he is losing out. And the larger CTA need to look at new ways of building their organizations and basically doing business. do not be afraid for hiring smaller existing shops with unique ideas and incorporate them into their organization. The argument that for a larger CTA to take on a smaller CTA doesn't really move the needle performance-wise for the larger CTA, I don't find exactly true. First of all, he should take on several smaller CTAs, and together they should move the needle for him. Second of all, the smaller CTAs are usually also scalable. At least my strategy is I have plenty of room to grow with rather large amounts still before the actual size becomes an issue for me.